Trish.
Okay, thanks, Dylan. Well, mortgages, they were the first victim of bad credit quality. The question now, will credit cards be next? Our next guest says credit card loans will be the next shoe to drop in the wake of the subprime mess. His name is Greg Larkin of Ininvest. He's right here with me. Greg just authored a report called Credit Cards at a Tipping Point. Now, also on hand, someone who disagrees with this, we have today's guest contributor, Jim Pethokoukis. Thanks for both of you being here. I'm going to start with you, Greg. Why do you anticipate this avalanche of bad debt happening now? And how much money are we talking about?
How much money are we talking about? We're looking at $18.1 billion of losses in quarter 1 of 2009. We predict that by the end of 2009, that will have expanded to $96 billion.
So nearly $100 billion.
Nearly $100 billion, which relative to the mortgage crisis isn't that big. But in terms of how that puts downward pressure on consumer expenditure and the real economy, it could make the recession a lot deeper and a lot broader.
Well, let's talk about this. I mean, is it basically a case of, people are delinquent on their cards, so they therefore don't have a card to go out and spend more money?
Well, it's a combination of having a backlog of bad debt, but that's not the new part of this. The new part of this is that banks don't want to be lending to those customers anymore. What people who had a huge backlog of bad debt have been able to do over the past 10 years is transfer into a new low-interest card. No bank wants to be that lender right now. And so what we're seeing is a freeze in the credit card market, which we think is going to trigger a huge wave of defaults.
And therefore slow the overall economy because people have that much less spending power.
Right.
Jim Pethokoukis, you say, the economy's maybe perhaps not as bad as everyone thinks it is, and we can get through this, and we don't need to worry about credit card debt being the next shoe to drop. Why is that?
I mean, to the extent that it's the next shoe to drop, it's already sort of kind of been dropping for a while. It's not like nothing has happened. You already have these companies they're raising their loan loss reserves in preparation. But listen, let's a little perspective here. This is we have about $1 trillion, maybe just shy in credit card debt. Mortgage debt is $11 trillion. So we're talking about, first of all, debt a tenth as large as what we saw with housing. And second, and I tell you, I hate to mention this guy. I'm very worried Dylan Radigan is going to jump in this little segment. But
I won't let him, I promise.
We had a big drop in oil prices. That is going to be really the equivalent of like a $200 to $300 billion tax cut for consumers. Gas prices are down. That's more spending power they have to pay off some of that credit card debt.
Okay, so what about that point? It's kind of like a tax cut.
Here's where I disagree, is that credit card debt has been defying gravity. Charge-offs on credit cards are currently lower than they were in 2002, lower than they were in 2005. If you couple that with the fact that real wages have been flat for 10 years.
That's not true.
Household savings rate has been zero.
Right.
How is that
Okay, well, look at that graph. Hey, Jim, take a look at this graph right here. We're looking there at real wages, and they look pretty much flat to me, the blue line there, and then look at the credit card debt outstanding.
First of all, listen, I will spend the next half hour saying why that number is wrong, why it's calculating inflation wrong, why it's calculating wages wrong. But I am quite confident that is completely wrong. Second of all, there's an upside to all that.
What's not wrong is that debt-to-income ratios are higher than they were 10 years ago, and the household savings rate is negative for the first time.
I don't want to argue the
since
income
Great
numbers.
Depression.
But I'll tell you, there is a plus side. You'll have people, more bankruptcies, people trying to walk away from the debt they can't pay. But there's also people who are normally, people who pay off every month. They won't be paying off every month.
Their marginal increase in the amount of credit card expenditure they're going to take on is a lot lower. That's not going to be enough to compensate for all the people that have taken on too much debt that are now going to default.
I'm an old law school student. That is a mitigating factor we might want to look at.
Hey, Jim, one of the things that struck me is I did a lot of research, called a lot of families to find out their situation on this story, and people were telling me that they were using credit cards right now to fund their daily expenses because in many cases they had lost their job. So as the unemployment rate moves up, what might that do to people's spending power and their debt levels?
Listen, I'm not going to argue that we're about to enter a huge expansion. The last thing this economy needs right now is 2 to 3 million more unemployed people. There's no doubt about that. But I have to say that in my house, my wife, my lovely wife Colette, runs the credit cards. We're like Pennsylvania Dutch. We pay it off every month. I have to say that.
You got a good CFO.
Absolutely.
All right. Thanks so much, Jim. Thanks, Greg, for coming.
Thanks for having me.
Appreciate it. For more on the credit card debt, tune in to my report on NBC Nightly News with Brian Williams. That's coming up tonight at 6:30 p.m. Eastern on NBC. Dylan.
All right, Power Lunch coming up top of the hour here. Bill Griffith with